Hey everybody, welcome to Investing with IBD. I'm Chris Gessel, Chief Content Officer for Investors Business Daily, and with me today is my good friend and colleague Justin Nielsen, who heads our research efforts.
Greetings.
And we're here today filling in for Arusha Paris. And how did he get this week off? Who let him go on vacation?
Well, I can't complain too much since I was on vacation last week, so I think you're the decision maker here. So your fault. I'm going to blame you.
Okay. And in your time off last week, did you run into any weather?
Well, we did follow Hurricane Barry on the way up. We were on a cruise, and so that made for an interesting Saturday night roll, I should say.
So you were on a cruise ship near a hurricane. That sounds ideal.
Right. But, they're so big, you hardly feel much.
Well, that's nice.
Yeah. Lots of thunder and lightning, though. It was a nice show around midnight.
Well, so let's talk about what we're going to talk about today. And we're going to start off with a market update and see what's happening with the market and where we think it's going to be going over the next few days and weeks. The next thing we'll dive into is earnings season is starting, and there's different strategies, things to remember in order to get the most out of earnings and avoid the pitfalls. And then we're going to take a look at a few stocks that are setting up ahead of earnings and maybe ones to really keep an eye on, and if they gap out, make plays with them, things like that. So let's begin with the market. And today we saw a little softness in the market, and we're talking on July 17th on Wednesday. And the S&P undercut its 10-day moving average for the first time in a couple of weeks. And usually what we see when that happens is a little bit more market weakness.
Right. And, for that reason, we did take our UPRO position off of leaderboard. That was actually a very, very profitable position that we've had for quite a while. And it's one of those things where, given the run that it's had, this isn't unexpected.
Right.
It's not unusual. It's very natural and actually constructive for the market to take breaks along the way.
Yeah, because we're up 13% on the NASDAQ since the very bottom of the correction at the beginning of June. So that's a lot. That's a big move in
just a
6
month's
weeks.
time. Yeah, 6 weeks. Yeah.
So we were seeing some a little bit of weakness over the last few days, where the market was in a very tight range and then would start easing at the end of the day, maybe down 0.5% or something like that. And after hours, speaking about earnings, Netflix reported and was down around 10%, maybe a little bit more than 10%. I guess their subscriber growth numbers missed by a mile.
Yeah, they were looking at 5 million as a target and came in at 2.7 million. So
I'd say that's
for new
a miss.
streaming subscribers. Yeah. Give or take 1 million. We were close, right?
So in after hours trading, that pushed the NASDAQ below its 10-day moving average.
Right.
And the reason that we talk about this is when the indexes are trending above their rising 10 days, that's a good time to be going in and being bullish. And then when you start pulling back and undercutting that 10-day, that's a time that you want to start stepping back from the market as well, and maybe taking a few profits. It's not by any means, we're not saying the thing's rolling over.
Right.
It's just this is tactical movements.
Yeah, it's kind of almost where you're playing with how aggressive you are. In the same way in a car, you're not going to go pressing on the gas as you're going through curves. This is, depending on what kind of car you have.
Okay.
I drive a Prius, so
All right.
I don't. But it's just one of those things where you kind of are constantly, just going with the market. And when the market kind of has these little pullbacks, nothing major, could be very minor. You don't want to be getting super aggressive, because then it's really hard to hold your positions through that. And,
Right.
You certainly don't want to be doing a lot of entering on the way down, because you just don't know how far down it can come. It's much better to see that strength come back in, and that's why we like reversals so much.
Yeah. Well, that's a really good point. If you're easing up when you think the market is going to pull back, and indeed when it starts pulling back, then your head's clear. You're not kicking yourself because you bought all these stocks right at the top, and now you're further off your highs than you'd like to be, because there are so many good opportunities when the market pulls back for a week or a week and a half and then turns around. That's where you can really jump in and start making a lot of money quickly.
Mm-hmm. Even better is if you're taking some of those profits on the way up, and so you're kind of naturally freeing up some cash, lowering your exposure as you get extended, and then you have that free cash to deploy again once you have another opportunity.
So the other thing that we want to talk about is, what's the outlook for the rest of the year? Now, by, I guess, conventional measures, the first quarter, or I guess the first half of the year, was great.
And a lot of that was the first quarter.
That's true. You're right.
Yeah.
But the point that we've made in the online and in the paper is everyone's saying, "Wow, 2019, it's such a great, strong year." Yeah, that's true, but it's really kind of an artifact of timing, and that we had a 24% correction on the NASDAQ that happened to end a week before the new year began. So we've looked at 20 to 30% corrections in the S&P, and then what happens over the next 6 months. And when we've got, I think, 5 of them going back to 1980 that we took a look at.
So that's 40 years. Not very many. There's this would be the 6th, but still, covering a 40-year period. And you were very specific for asking for the 20 to 30%, not over 30%.
Right, because it doesn't make sense to compare like a 2007, 2008 type correction with a 20% correction when the market's down more than 50%. That's a completely different beast. So we were looking for moderate bear markets. There were 5 of them. The average gain in 6 months after the bottom, I think, was around 34%, and I think we ended up about 24% in the first half. So on a calendar basis, that's great.
Phenomenal.
Yeah.
Oh, yeah. That's a great year.
But after a correction, not so good. And I think the big thing that's been weighing on the market in this rebound has been the trade war and all the uncertainty around that. In fact, we just saw a little bit just yesterday, because we had Balzun on Leaderboard and Swing Trader, and that news came out with Trump saying, well, this might take a little bit longer, and man, that thing dropped like a rock.
Reacted immediately. So again, to put the current action in perspective, we've had a 24% gain, as you mentioned, in the last the 6 months from the bottom, and that basically matches what happened at the October 2011 bottom, when we had all those global recession fears in kind of July, the summer of 2011. Those are the 2 worst, so far. The next one is 1990, where it was only up 29%, but then from there you get 31%, 42%. That's a big difference.
Yeah. So I guess the takeaway from all this is we've been lagging a little bit, and we think the reason the market's been lagging is because of fears over trade. So if that gets resolved, hopefully sooner rather than later, then maybe the back half of the year will really come to life, and that would be fantastic. Because remember, when you step back and look at the market, and if you take a look at the S&P 500, especially on a weekly chart, you go back to the beginning of 2018 and where we are now.
Right.
The S&P 500 is up just 4.3%, something like that.
Maybe even a little bit less after the close.
Yeah, after today. You're right.
Yeah.
So over more than 18 months, that's not much advancement. And so I think there is a lot of opportunity, especially in the broad market, for us to really make a nice move here. And the other nice thing is that, coming out of the correction, the S&P especially, if you take a look at that chart, it broke out of a cup with handle pattern, and it's still holding above that buy point. So that's all good too. So I think there's a lot of things, that would indicate that there could be further gains to come. Of course, if the trade war just blows up and really pushes different countries into recession, and then that catches up with us, then all bets are off.
And a lot of people are already kind of looking at the Fed as the savior in some regards to cut rates and hopefully soften that blow. But as you've said a number of times, the seeds of recession have been kind of planted already.
Well, hopefully that doesn't come to fruition.
Right.
The other thing I've been noticing about the market, and it's kind of one thing I look at every day in the mornings when we're going through and just seeing how everything's setting up. There's a screen on MarketSmith, RS line at new highs, and it's a great tool. I find it really useful during corrections because that's the easiest way to find your leaders. When the market is going down and you've got growth stocks that are outperforming the S&P, therefore their relative strength lines are at new highs, that's just like a huge billboard saying, put me on your watch list. I could be a big leader. And in fact, that's how we found a lot of the big names in the first quarter. But I still look at this list all the time just to kind of get a feel of what's moving in the market. And lately, I've been noticing not everything, but there's a fair number of what I would call kind of pokey leaders. One is Tetra Tech. It's a pollution control services company.
Not typically what you think of as growth industry, right?
Right, yeah. And, I think the numbers are probably in the low double digits or something like that. But it's up, more than 20% since it broke out a few weeks ago. Scott's Miracle-Gro, another of the big growth names out there.
And that's SMG as the ticker symbol on that.
So that's its RS line was hitting a new high today. And another one that caught my eye was Brown & Brown Insurance Brokers. Insurance brokers are a close second to big financials, as in J.P. Morgan, Citigroup, and the like. These huge financial stocks that get a lot of attention, but they don't really outperform the market. So anyhow, when I see insurance brokers on the RS new high list, that's another sign. But on the other side of the thing, page, we've got PagSeguro, which actually has been going vertical. So if anyone owns that, you might be looking at taking some money off the table. Coupa Software, one of our big leaders early on, continues to hit new highs. It's been acting really good, and its RS line is hitting new highs. And Adobe, its RS line was at a new high. So it's kind of a mixed bag, but I guess whenever I see Scott's Miracle-Gro on that list.
Right. You start pausing, huh?
Right, exactly.
And yeah, I think Scott's Miracle-Gro, I mean, just to kind of reiterate your point, it's got an EPS rank of 30. That's
yeah, it would never be on my action list. All right. Well, so with the market, we think the market is poised for a pullback. No sign yet of anything more serious than that, but it's a time to be a little defensive and take some money off the table and get ready for the next move up.
Distribution's raised a little bit on the NASDAQ, but we don't have any big distribution. I think we only have one day that's down more than 1%. Everything else is, and it's kind of spread out. It's not clustered. When you see it clustered, that really kind of changes the look of things and how serious things might get.
So just we're expecting a pause more than anything else, but we'll see how that all plays out. Speaking of a pause, we're going to take a quick break, and then we're going to dive into IBD's 5 key tips for playing the earnings season, which is just kicking into high gear. We'll be right back.
Want to find stocks like the ones on this podcast? A lot of the best names we talk about come from IBD's exclusive stock lists, like the IBD 50 and the Big Cap 20. Whatever type of investor you are, we got a list for you. You can access every one of IBD's lists, plus stock ratings, exclusive analysis, and one-on-one coaching with a membership to IBD Digital. It costs less than $1 a day, but for podcast listeners, we're offering an even better price. Go to investors.com/podcast offer right now and get your first 2 months for only $20.
Hey everybody, we're back, and in this segment we're going to be talking about earnings season and how to profit from it and avoid some of the pitfalls. So there's really 5 things that we want to talk about. Justin, why don't you kick it off with the main point
Yeah.
in earnings seasons.
The main point is don't buy immediately before earnings. If you're looking at a week before earnings, it's just too risky. It's very hard to get enough cushion before that time, and earnings are they're too volatile. Once that earnings report comes out, there's a lot of reassessing. The way things used to be was, you would have the earnings report would come out, and a lot of the analysts had kind of already talked to management, and they had the whisper numbers, and everyone there was no big surprises a lot of times. Now, after Regulation FD, that's fair disclosure, came out in 2000, that kind of changed things. Management, you have to be quiet. You can't give someone information that you're not sharing with the whole public. So that keeps things fair, but it also keeps things to where
painful,
right? The information is not flowing freely, and it just comes out. And so all of these people are trying to make an assessment immediately of what those numbers mean. Sometimes you see a lot of volatility afterwards where they're like, oh, that's really bad. Oh, wait a minute, maybe it's not so bad. There was currency, fluctuations, or there's just a lot of, I think, snap decisions and analysis that can change, and it can be tricky.
Actually, if there were one regulation I would overturn, it would be Reg FD, because it doesn't actually help anyone. Mm-hmm. And
it's a good idea. I mean, I like the idea behind fairness. It just has the unintended consequence, unfortunately.
Because before that, in the 90s, that was a wild time in the stock market, mm-hmm. but I don't recall any earnings gaps, especially down gaps, sell-offs from investing at that period, because the reason was that the bad information that would have been released in earnings and hit everyone at once had kind of been trickled out. And so stocks mm-hmm. that were doing okay, now they were already starting to roll over. They weren't acting right ahead of earnings. And so either you were selling them or they just never got on your radar to begin with. So that was such a huge change and such an unintended consequence, which I still wish it never happened. Mm-hmm. But we've come up with ways to deal with it, and one is don't buy ahead of earnings. If you absolutely want to buy a stock ahead of earnings, we highly recommend that you use an option, and typically really with a stock that you think is going to be a potential leader. It's like you really want to be in this. It's in a first or second stage base, and you just don't want to wait and chase it on an earnings gap. So in that case, options are a pretty good deal, but again, they can be expensive, and you don't want to buy a whole position with an option.
Mm-hmm. And people need to understand that we're really not trying to make a profit off the option itself. It's really, you want to own the stock, and you're willing to buy it at the strike price, and plus whatever premium you're paying up for it. But it just allows you to participate if it does have a nice gap up or moves from there. It allows you to participate while capping your risk,
right?
Making it so that you don't have a 20% gap down that you just can't do anything about.
And the reason for that is because when you buy an option, the most you can lose on the option is the amount that you paid for the premium.
Right. And we that's always a fraction of the price.
Right. So we always take the premium cost, and let's say it's a $100 stock and the premium is $4. Well, mm-hmm. 4 into 100 is 4%. We're okay risking 4%, especially on a partial position. That's not a big deal. And that's kind of the thought process on mm-hmm. why we use these. A lot of straight option players would say, well, why would you be buying an option right ahead of earnings? The
implied volatility
is going crazy.
Yeah. Mm-hmm.
And back to your earlier point, this is really a way to just, we're trying to buy the stock. It's not really an option play. Mm-hmm. So that's one way to get in ahead. The other is just buy the earnings gap. So Tell me, what's your typical approach when you buy a stock on an earnings gap?
Well, and this is kind of getting to another point here. First of all, you have to do your homework. You have to be ready, right? You have to be looking at, okay, what's out there that's setting up, and what could potentially, what's coming out with earnings, and what could potentially move above an area of resistance. So sometimes I'll have maybe 6 stocks that I'm looking at one time, and I'm just looking at how do they open? How's that first minute? How's that first 5-minute bar? Where does it go from there? Is it gapping up and holding on to those gains and even adding on to them? Or does it gap up and then slowly, turn into a red candlestick, and it's it's below the open, it's at its lows, and that's not what you want to see.
Right. So typically, in those first few minutes of trading, you want to see the stock holding onto its gains, maybe adding on to them a little bit.
Mm-hmm.
Basically, you want an arrow up bar, meaning the close is higher than the low in the bar and all that kind of stuff. So
and higher than the open. A lot of times. Mm-hmm.
Exactly. And the other thing is when you see a big reversal in the first 5-minute bar, that is a bad sign, and that stock may just keep reversing.
Right. Mm-hmm.
So, and then, later on in the day, you could even wait till the first hour or wait till the close.
Mm-hmm.
And if it's holding and doing very well, go ahead and make the purchase, because we know that big breakouts on earnings, breakaway gaps, even when they seem so extended, those are stocks that will often make big moves.
Mm-hmm. Yeah, and this is something that we especially really got drummed into us when we were doing our breakout stocks index research, and there were so many of those stocks that were up so much, and it would be scary to buy them, and we found putting them in an index was kind of nice, not as scary, but there's so many of them that just keep on going up and up, or they might consolidate those gains for a little while, and that can even give you another opportunity. Mm-hmm. Let's say it just kind of holds tight for a few days, and then it could potentially give you another entry point.
So you can always use options, just buy the breakaway gap. But another thing you can do ahead of earnings, especially if you're holding a stock, maybe take some money off the table.
Mm-hmm. Yeah. This is something that a lot of people forget. It's easy to forget that one of our rules is taking 20 to 25% profits when you have them. Yes, every now and then you're going to have that stock that could be a potential big winner. That's what you call your conviction stock. But don't treat every stock like that. Just don't think that you're always going to be hitting a home run. I made that mistake very early on, and Bill quickly corrected me very gently on that.
I continue to make that mistake.
Right. Yeah. It's and the mistake I was making was thinking that everything I touched was going to be gold. Now granted this was in my 20s, so of course, but
king of the world.
Yeah, right. But, Bill told me, look, I've been doing this for 50 years and I only expect 1 or 2 out of 10 trades to be one of those big winners. The rest I'm fine, taking the 20% gains or cutting my losses real small so I can move it into something else that has bigger potential.
Now, you kind of touched on this already, but another thing you want to do going into earnings is build your watch list.
Right.
It's one thing to kind of react the day of, this thing is up big and maybe it's a breakaway gap. But if you really don't know what's going on with the stock ahead of time and you don't understand the business, the odds are against you that you're going to make some good trades. So it's really important.
Then you're relying more on luck in a lot
Right.
of ways. I got lucky this time, and it's very easy to say, I had a good outcome, so that was me being smart.
Mm-hmm.
But if you didn't do your research, you have to kind of really look at what was your process, in getting that good outcome.
And then finally, what do you think is the final step in this whole process?
Well, here again, I remember a quote from Bill's book. What was it? There's the quick and the dead, or something like that. You just really can't hesitate when you start seeing the stock move in a certain direction. You have to realize that there is mass psychology in play here. There's a herd mentality, and that can build on itself. Information cascades is what they call it in behavioral economics. And so if you're on the wrong side of that, thinking, I'll just wait for a little bit to see if it gets better, that's not necessarily going to work in your favor.
Or if it's going to get worse. I mean, when you're holding a stock that's now gapped down and you're making, I've got a big profit on it, I can sit through this correction, things like that. I mean, that's the other side of this. When there's a big gap down, maybe what everyone was thinking about the stock no longer applies. And if the market, especially these big mutual fund investors, decide they're done with it, and they can that's when stocks get hammered, where they decide, get me out at any price. I don't want to be a part of this anymore.
Yeah, it's like a bunch of people rushing out of a movie theater at the same time. You don't want to get trampled in that.
So, earnings season is just getting underway. There's been some bank earnings this week. We mentioned Netflix earlier, so that was down after earnings. There's going to be, I would say over the next week or so, there's a few interesting stocks, and we'll talk about them in the next segment. But I think it's going to be a couple weeks before we really start seeing more of the leaders coming up. So again, this is a great time to go and do your research and see what's coming up. And again, if we have in IBD in the paper and online, the earnings preview, and that gives you the earnings that are coming up over the next week. And MarketSmith, there's upcoming earnings as well. And I'll just click on composite rating and then just start working my way down and just seeing what's interesting and setting up. So doing that homework ahead of time is so key.
And keep on asking yourself those key questions, as you're going into an earnings season. How's the market? Sometimes earnings seasons will have their own little personality. There's some that are like very forgiving of bad news. There's some that the stock will go down if the CFO coughs in a weird way. It just doesn't matter. It doesn't matter what you blew out earnings, but it still got killed. So what kind of environment are you in? How's the market? How extended is it? What is the group like that you're looking at? We had the rail stocks. CP, Canadian Pacific, Canadian Pacific was great yesterday. CSX, not so good today. I think it was down 11% or something like that.
That's
at some point.
Big move for a railroad.
For a railroad stock, right? So, what's going on in the group? With competition, that can kind of give you a sense of what might be happening there. And what are the stocks looking like? What are the setups? If you're looking at stocks that aren't setting up properly, why even bother trying to play?
Yeah. That's it. That's the easiest way because looking at charts tells you so much and can really filter out a lot of things that aren't even worth your time. All right. So with that information, we're going to look at a few stocks that are setting up ahead of earnings and where the numbers might be looking good, and we're going to dive into those right after the break.
Hey guys, Arusha from Investing with IBD here. Make sure to subscribe, rate, and review if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Welcome back, everybody, to Investing with IBD. I'm Chris Gessel, and with me again is Justin Nielsen. So, Justin, we're going to take a look at a few stocks that are looking pretty good ahead of earnings, and we'll be reporting earnings over the next week or so. First up is a defense stock, and defense stocks have been pretty good. Tell me about it.
Well, yeah, you had there was a while there we had LMT, Lockheed Martin, popping up on our screens, and the group seemed like it was doing pretty good, and HXL. Hexcel was one of them. Now it broke out. I think, if I remember correctly, they were talking about guidance in late May, and that's something that spurred the breakout. And it's out of its buy range. It's traditional buy range at this point. But what these guys do is they do aerospace composites for airplanes, and especially with the U.S. Department of Defense increasing their budget, you've got the F-35s out there. They're involved with that. So I think I read somewhere it was like 166% increase in the budget for airplanes or something. So given that, the composites, as what Bill would call a cousin stock, you have like when the jet airliners were doing very well and with commercial flight coming on, Monogram Industries was doing very well because they created the toilets that went into the planes. So
I think they're doing more than toilets.
Well, that was a big thing. I just remember him always telling the story of the toilets there.
Right.
So Hexcel here is basically, if you look on a weekly chart, it's kind of created a 3 weeks tight here, and depending on how this week ends, it could actually be 4 weeks tight. If it closes in the 81 area, 81, 82 area, it could be 4 weeks tight, and it's reporting Monday after the close. Its conference call is going to be 10 o'clock Eastern, 7 o'clock Pacific. So that means it's during market hours. So that's just something that happens sometimes where you'll be, going along, and then the conference call happens and something can, come out in the conference call. So sometimes you have to be very cautious in that time before the conference call. So that's just something to be aware of here with Gessel.
Yeah, when I look at this stock, I mean, I don't expect this to be a huge winner. This is something where you get 10, 15, 20% on. Longer term, it's got a fairly flat relative strength line, although it's been outperforming the S&P since the beginning of the year. So again, it's not a huge winner. This is a trader, a 20% or however you want to refer to it. But that the numbers are kind of good. They've been accelerating from 12%, 13%, 17%, 24% earnings growth over the last 4 quarters. Sales have also been accelerating up to 13%. So they're solid numbers, not huge numbers. And the estimate is for 19% earnings growth. So if they beat that and they're in that low 20% range, that would be kind of interesting. And again, it's all going to be about the guidance and also what's happening in the market as well.
Right. Yeah, that's a big factor. If we're amidst a pullback, now sometimes that can work to the benefit of the aerospace, defense. Some of these kind of counter-cyclical. We had a big move in Kirkland that was kind of counter to what the market was doing at some points, and then it seemed like it was working with the market too. So it just really didn't care. But be aware of those industries that can kind of sometimes act in a manner that's different than the market.
Yeah, especially if we think the market's going to be soft for a week or so. So that's Gessel, HXL. The next stock we want to talk about is EDU, and that is New Oriental Education. This has been a leader on our list for many years. It comes on and off, and there's also a companion stock, TAL Education. And do I have that name right? Is it TAL?
Yeah. They had a symbol change. I remember we had it on Swing Trader as a different symbol. I can't remember. It began with an X, though. Yeah.
So we've been watching EDU. It's been on our watch list on Leaderboard, but hasn't acted really well. And part of it because it's a Chinese stock. Whenever there's a little bit of nervousness over the trade war, those are the first to go. But tell me what the outlook is for EDU right now.
Well, and one thing that happened on EDU, just to be aware, is that in that Q4 correction of 2018, it did have a deeper base than we normally like to see. So it was over 50%. Usually things over 40%, that's getting excessive. But one of the positive things is it kind of formed this nicer, tighter base after that. So that's kind of a benefit of letting it kind of play out, letting it kind of make a little bit of a move from there. This is a much tighter base, much more. It just, let's see, it went from like a high of maybe 97, 98 down to 80. So a much more mild correction, kind of forming this cup shape. Tried to break out of that cup without a handle, and it failed. But that kind of sets up another potential entry here. So it kind of almost formed a handle, which is fairly typical. Sometimes you'll get that where it's just a little bit premature on that breakout. It needs a little bit more time, and so here again, the earnings could be a catalyst here if it. Education in China is a big thing, whether it's learning foreign languages. There's a lot of English being taught in these schools, a lot of preparation for the prep exams in China, which are a very big deal. It's got the earnings Tuesday before the open, so July 23rd before the open is when the earnings come out on this one.
And the estimates are for 16% growth, so that's below the 21% it reported last quarter. Again, if they beat, you could see some acceleration. Sales are they've been in the 30% range and the 40% range, and they've pulled back into the high 20s. So it's still a stock that's growing pretty well on the top line. It all depends on how it acts, because it really seemed that it wanted to break out, and it poked above there. Maybe volume wasn't so great, and now it's pulled back. And it's these sort of second chances. If it gaps above that that high from 2 or 3 weeks ago, that would be an actionable point to jump into the stock.
So it is a Chinese stock. Just you have to know that. Not something that would necessarily be affected by tariffs. It's not like they're doing goods or anything like that.
But more concern over weakness in China's economy.
Exactly. So
fewer
that would be
people
the issue.
Sending their kids to school.
Right.
Or at least to...
Now, also in the education realm is Chegg. That's CHGG, but this is actually based in Santa Clara, California. So this is kind of involved in education as well, but printing textbooks and doing things with tutors, teaching writing, test prep, internships, all sorts of things like that. This is a newer company. When did it come out? It was 2016. 2013. I thought it was much more recent, but it was really 2017 that this got on our radar because it kind of formed this long base. In 2017, it just roared, and so it just kept on going up that whole year and through a lot of 2018 as well. So this is something that we've been watching for a while, and it's got consolidation here. Now, again, we're looking at hopefully early stage basis here. So this is just a second stage base. Yeah,
because it reset its base count during the correction, and then it had a decent move coming out of that breakout. And actually, it's actually broken out. It broke out last week, and it had a nice, powerful breakout. I think the volume is, a big blue spike, just what you want to see. So that was great.
164% above average.
Right. And so now this week it's held very tight. It's just barely changed for the week. And when does it report?
So that one I believe is next Monday, not the one coming up, but July 29th.
Oh, okay, so the last Monday in July. So at that point, it could be looking at a 3 weeks tight if it continues trading in the way it has been trading. And again, we kind of like these. A lot of times stocks will break out ahead of earnings and then pause and consolidate. And so this would be your chance to jump on it afterwards. And it's really right now, it's at the top of the 5% buy range. So it's not truly extended. And again, if they follow up their pre-announcement with even better results, then that could really get the stock moving again.
And this definitely is one with some very high earnings growth. It's got an EPS rank of 99. The growth rate, the 3-year, 5-year growth rate is 128%. So that's 128% annually. Just imagine if you were doing that to your salary. So that's a pretty high bar, and quarterly numbers have been looking great.
Although they're not super profitable, so they're still. The last quarter, they earned 15 cents, so they're coming off a low base, which is one reason why the numbers look pretty good. But the sales numbers are solid. They're in the 30% 2 quarters ago, 27% last quarter. Not that big of a company. $5 billion in market cap, sales of $342 million. So. It can be a little more volatile, but there's the alpha on this stock is 15, and so alpha when we talk about alpha and beta, alpha measures how much a stock moves independent of the market, and we like to look at stocks where the alpha is over 0.1. So when we say 15, 0.15.
Yeah.
So that's a good sign,
and it does for being a small company, it still does have that liquidity. It trades, 1.4 million shares a day, and it's not a cheap stock. It's $43, so that's respectable. So that's a decent amount of dollar volume. So this isn't something where you feel like institutions aren't able to play in the field. This is got some liquidity to it.
Right, and even when it was going sideways, there was net accumulation by different mutual funds and other institutional investors. So they've had 163 new buyers, 240 added to their position and 245 reduced positions. So, net positive accumulation. So that's always a good sign, especially when a stock is going sideways as it has for the last few months.
Mm-hmm. And you see that in a very positive up-down volume number. That's 1.9. So that's phenomenal.
So those are the stocks we suggest you take a look at coming into the next week. That's Chegg, CHGG. EDU. I always forget because we only talk about stocks with tickers.
New Oriental Education and Technology, I think.
And then Hexel, HXL as well. And after that, then we'll start seeing more of some of the big name leaders coming out and reporting their earnings as well.
Microsoft is this week. So, that's a big weight in a lot of the indexes. And so it's worth kind of noting what happens there because that can affect what's happening with the indexes themselves and kind of set the tone.
Right. Yeah, and that's a good point because as we kicked off today's episode, the market's acting a little, soft, pulling back somewhat, and that'll be interesting to see how some of these big names affect the market indexes. All right. Well, that wraps it up for us today. It was always fun to come on and give Arusha a hand even when he's not here. But he'll be back next week, and joining him is Dan Fitzpatrick. He's president of Stock Market Mentor and stockmarketmentor.com. So thanks for listening, everyone.
And happy trading.
And for this week's Nielsen charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube.
If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.